Greetings everyone. Today me and my group will be presenting a presentation on You Can Be a Stock Market Genius by Joel GreenBlatt. Further, we will also discuss the current awareness. Everyone wants to get invested in the stock market. They want their exposure in the equity market and generate great return on their capital. But there are few problems in this industry. The problem is that every brokerage firms are systematically biased and their biasness is linked to the incentive that they get. So the first bias is the buy trap. They create a buy recommendation because that creates more trading activity and more people will invest in this new business or new buy recommendation. That will also generate their commissions. The second is they avoid the sell recommendation. Instead, they use the word hold or untimely. This is because they don't want to lose their access to the management by critically writing a report on the company. The third is the herd mentality. Everyone is feared for losing their professionals. They will just follow the crowd and just publish a report which is already published in this industry. Every every report will be Every report will same, the recommendation will be same, and there will be no difference in this report. This is because analysts don't want to go against the crowd and risk their professional lives. So, what is the solution for this? Solution is just do your homework. You have to manage the risk and you have to have a great portfolio strategy. And how do you manage the risk? It is not beta. Beta just tells you the volatility of this stock. It does not tell you how much you can lose. Risk, you need to focus on the downside. Even if you generate very low to moderate returns on your capital, but just don't lose your capital. Because if you lose the capital, that's over for investing. The third is having a still goal is margin of safety. It is a cushion between the current purchase price and the asset true value. It means that even if you go terribly wrong, you can generate safe returns and avoid losing your capital. The portfolio strategy says that you have to pick your own spots. You don't have to diverse your portfolio and have many stocks, and that is totally a myth. Only 8 stocks can diversify your portfolio by 81%. So limit your portfolio by having few stocks that you understand. And also keep cash by hand because that will avoid you to have forced selling at the downturns. So how do you do your own homework and pick your own spots? There are many situations where you can find great returns just by getting involved in this. Let's understand spin-off by an hypothetical example. Imagine there is a company that had two businesses. One was the retail, other was the hotel. Retail one was actually making great profits. Right now, let's understand by rupees 100. And the hotel one was actually a loss making, and the loss was rupees 20. The PE to the whole company was given 15. Now, what becomes the market capitalization? Pat into the PE, which is 1200. Now, what happens? Company decide to split both the businesses. The PE rating for the parent company, which is retail company, is actually saying a PE re-rating. Why is that? Because investors which were interested only in the retail are now more interested in this because now the hotel segment is separated. Second, this is a profit making business, right? Now, the hotel business, even if it is loss making, it cannot have a negative market cap. At least for the least, it can get a 1 to 2 of P, right? So let's calculate the market cap of both the companies. The P for the retail company is 30 and the profit is 100. So the market cap is 3000. Let's take P for the hotel as 1. So the loss was 20 and it will get at least 1 of P so the market cap is 20. Now the total value of both the business is 3020. You did nothing, you just invested 1200 rupees in this business. The spin-off happened, and now your total value has increased to 3020. But why are the spin-off very great profit engines? Understand that the institutional investors who are interested only in the core business of the parent company will sell the shares of the spin-off company. They will sell it regardless of what the price is, and that will create a very discounted price for the buyers. Now, what happens is typically the spin-off companies are 10 to 20% smaller than the parent company. Even if the institutional investor wants to invest in this spin-off company, the market cap is so low that if they have a trading buy, that will increase their stock price to the point that will diminish their returns. So they just don't get involved in the small cap companies. The second is the index constraint, which means that a few index stocks who have the stocks pick out from the index don't usually invest in the spin-off companies because they are not a part of that index. Now, the third is unleash entrepreneurial forces. What happens is when the management of both the businesses separate, there is more focus on the businesses because that is linked to their incentive of stock option plans. They will increase the performance of the company, that will also increase their profits. Let's quickly take a look at the cheat sheet to win the spin-off opportunity. Institutions don't want it because there might be size problem and they just might not be interested in the spin-off business. Insiders want it badly. Now, this is very strong signal indicating that management are betting on the spin-off businesses. They have a hidden reason to make the stock soar. Third is hidden value getting revealed. Sometimes the parent company let go of the bad company and spin it off, but actually they are betting on the turnaround of that company. Let's understand a demerger situation through a case study of Briggs and Stratton. Now, this company was a large company of engines. It used to make engines, and it had a small division of small automotive locks. It was less than 10% of their total sales. And now what happened? They separated the two businesses. As soon as they separated the strategic security from the parent company, the institutional investors were forced to sell their stake because their market capitalization was lesser than the $100 million. Now, this created a discounted value for the stock, but there was a hidden growth catalyst. It was that Ford was going to be a new major customer for this static security. It was going to make 16% of the total sale by the static security, and which was not yet reflected in the earnings. With the earnings of $1 per share, the analyst suggested that the PE for this stock should be given at max $10 to $15. But what actually happened, what the outcome was of this demerger was the company stock rose from 10 to $12 to directly $18 in just 8 months. This was a 50% plus of returns just by getting involved in this demerger. Let's also do a real application on an Indian company. Geo Financial Services, which got spin-off from the Reliance industry, was one of the major spin-off. What happened was, as soon as Geo Financial Service got separated from the Reliance industry, It was temporarily included in the Nifty 50 index. And after few days, when it was removed from it, the investors, institutional investors, were forced to sell millions of shares. And that also resulted in a 5% hitting a 5% lower circuit. Down, the stock fell significantly in September, creating a discounted price for the investors and rose to 350 as the forced supply was absorbed. Now, there was a hidden asset in it. Geofinance had a massive stock in the Reliance industry, and if you remove that share value, you are almost getting that company for free.
My name is Yugbed, and today I'll be explaining a case of a corporate split that looked like a disaster, but was actually the opportunity of a lifetime. We are looking at the famous Marriott spin-off. So, in the 1980s, the Marriott Corporation was a machine. This strategy was simple: build hotels, sell them to investors, and keep the profitable contracts to manage them. It was perfect business model until the 1990s rolled around. When the market crashed, the music stopped. Suddenly, Marriott couldn't sell the hotels they were building. They were stuck with billions in debt and massive buildings that nobody wanted. The company was sinking. To save the ship, CFO Stephen created a radical plan. He decided to basically split the company into two. So, what did he do? Bolan Bench basically divided the empire into two separate stocks. On one side, you had the Marriott International, and this was the good company. It got all the lucrative management around it and all the good contracts. It was highly profitable, and it was a almost debt-free company. It was the stock that everyone wanted. On the other hand side, you had the host Marriott. This was the bad company. It became the dumping ground for all the unsellable real estate and essentially all of the parents' companies did. To average investors, Host Marriott looked like a toxic waste. It was a speeding Mack truck loaded with bad real estate heading for a cliff. So, this is where the opportunity appeared. It wasn't just that the people dislike Host Marriott, it was the big institution were practically forced to sell it. So, let's say there are three specific reasons why Wall Street dumped the stock. First, the size rule. Host was small, only about 10 to 15% of the original company. For a giant pension fund, it was too small to be worth the paperwork. Second, the leverage rule. Host was drowning in debt. Many funds have strict rules that forbid them from owning companies with that much debt on the books. And third, the business mismatch. Investors bought the original stock to own a hotel manager. They didn't want a real estate company. Basically, this created a forced selling frenzy. The price crashed far below what the buildings were actually worth. So, while the crowd was running for exits, a few contrarian investors started reading the fine print. Okay, so they noticed something strange about Stephen Bollenbench, the brilliant guy who designed the whole plan. He decided to become the CEO of the bad company. Think about that. Why would the man who saved the ship choose to jump in the leaking boat? It looked like a financial suicide, right? Unless he knew something the market did. The author realized that Bolenmensch and the Merritt family, who kept a 25% stake, had a massive skin in the game. They were betting their own fortunes that the toxic company would survive. And now, talking about the magic of leverage, let's come down to the math of leverage. Let's simplify the numbers from the case study. Imagine a host Marriott owns $30 worth of hotels, but they owe $25 to the bank. That leaves only $5 of the value for the shareholders. Now, look what happens if the real estate market improves just a little bit, say 15%. The value of the hotel goes from $30 to $34.5. The debt stays fixed, so all that extra value flows directly to the equity, basically to the stock. The share price jumps from $5 to $9.5. A boring 15% increase in the business value. resulted in a 90% gain for the stockholder. That is a rocket fuel. And because the good company had lent the money to survive and the family was involved, the risk of the bankruptcy was actually much lower than it looked on the paper. So, what is the conclusion? This is the classic case study that teaches us that what it means to be a contrarian. It's just not doing the opposite of the crowd, that just like jumping in front of a truck because everyone else is on the sidewalk. True contrarian is about investing, is doing the work. It's looking at the toxic waste, doing the math on the debt, checking the incentives of the insiders, and realizing that the crowd is selling for the wrong reasons. If the insiders are buying the bad company, you might want to follow them. But no. So, another topic which I found interesting in this book was the spin-offs via right offering. Usually, when a company spin-offs a new business, they just give you the shares for free. That's great. But today, I want to talk about the spin-off where they ask you to pay for the new shares. It sounds worse, right? Why would I pay for something which I could get for free? Because these are often the single most profitable events in the stock market. It comes down to two concepts: the family discount and the lazy neighbor. So, coming on to the family discount, first, the family discount. Imagine a company is a family and they want to sell a car worth $10,000. If they sell a car to a stranger, the laws say they must get the highest price possible to be fair to the owners. But if they sell that car to you, the shareholder, the family, there is a legal loophole. They don't have to charge full price. They can sell it to you for $2,000 just because you are a family. Companies often price this right offering artificially low to make sure the deal goes through. It is an instant bargain, but it gets better. This is the lazy neighbor bonus, or what we call oversubscription. The company sends a letter to every shareholder saying, "Do you want this $10,000 car for 2,000?" But here comes the reality. Most shareholders are lazy. They hate paperwork. They ignore the mail. They let the offer expire. So the company says, "Okay, does anyone else want the share that lazy people didn't buy?" So if you are smart, you raise your hand. You get the scoop up all the unclaimed share at the same bargain price. You are literally profiting from other people's apathy. So the next time you see a right offering that requires you to write a check, don't ignore it. It might be the family selling you a Ferrari for the price of a bicycle. Thank you. So the next case study will be explained by Meet. Thank you.
Thank you, Yog, and hello, everyone. So, let's just start with a very simple and basic question. Have you ever wondered that why people tend to look onto something which is very simple and familiar and avoiding what feels complex? Today's case shows how complexity, when understood, can create extraordinary rewards. So, this story starts with Viacom wanting full control of Paramount, and although it had already acquired 50.1% of equity stake for cash, it still needed to purchase the acquired and remaining 49.9% of its stake. So instead of using a simple structure, Viacom deliberately designed a complex multi-security transaction. So rather than plain equity, Paramount shareholders received a bundle of common securities such as Viacom common stock, exchangeable subordinated debentures, contingent value rights, and two warrants with $60 and $70 strike price. As a result, shareholders stopped being simple owners and become holders of equity, debt, and derivative like instruments. And this is when investors were forced to analyze something unfamiliar, and most choose to sell instead of think. So, the most critical feature of the deal was the CVR, quietly disclosed in the proxy statement. The CVR guarantees that 1 year after the merger, the combined value of Viacom stock plus the CVR would be at least $48. This created a downside floor, and no one noticed. So, for an example, if Viacom stock traded at $40, the CVR would pay $8, ensuring the investors still receive $48. For an example, you are buying a product with a protection of refund guarantee. If the value drops below a promised level, you're compensated. However, most shareholders ignored this safety net because they never read the proxy. The author repeatedly warns that the real information edge often comes from documents that most investors refuse to read. After the merger closed, many Paramount shareholders saw the strange, complex securities felt uncomfortable, and sold the stock immediately. This made the prices fell, but it was not because the business was worsened. It was because complexity scared people and investors away. This illustrates a central philosophy of the book and answering my question that when something looks messy and unexciting, that is often where the value hides. The so once the selling began, individual merger securities started trading at inefficient prices, especially the debentures. These debentures had a face value of $70, yet they were traded for only around $42, 60% of face value. Also highlighted in book that markets are most inefficient when securities are thinly traded and poorly understood. The reason this mispricing existed was not risk but the ignorance. Hidden in the proxy was a powerful clause. The 5-year $70 warrant could be exercised using $70 face value of certain merger securities, including these debentures. So, as previously said, opportunities are sometimes found where people least expect it to be. This aligns with author's philosophy also that the best investment often comes from understanding the mechanics rather than predicting the outcomes. This clause allowed investors to buy $70 face value of debentures for $42 and then use those debentures to exercise warrants. Economically, this meant acquiring Viacom stock at an effective price of $42 instead of $72, which it should be trading. A simple example is buying a rupees 7,000 product with a voucher for rupees 4,200. The value comes from structure, not speculation. Importantly, investors still had the CVR guaranteeing a $48 floor price after 1 year, which limited the downsides. This created what Greenblatt calls an asymmetric payoff, limited downside with substantial upside. He stresses that you do not need to be right about the future to make money. You need a favorable risk to reward structure. Greenblatt and similar investors didn't forecast the Viacom's earning or the industry growth. They just simply read the proxy, which was mostly boring for many of the people, and they connected the pieces. Viacom benefited strategically by winning the acquisition, but the real money was made by investors who were willing to do boring and detailed work. So the final key takeaway of this case is always read proxy. No, this is not the case. It's a case shows clear lessons that complexity and paperwork are not enemies. They are often the investor biggest allies. This next case study introduces a classic risk arbitrage situation where the math initially looks very attractive, but the risks are hidden beneath the surface. HBJ or Harcourt Brace Jovanovic agreed to acquire Florida Cypress Garden in a stock for stock deal, offering 0.16 shares of HBJ for each Cypress Garden share. At the time of the announcement, HBJ was trading at $51.88, which implied a takeover value of roughly $8.30 per Cypress Garden share. However, the market price of Cypress Garden after the announcement was only about $7 and 50 cents, creating an arbitrage spread of roughly 80 cents per share. On the surface, this looked very attractive, a 10.67% return in just 3 months, which translates to around 43% return on an annualized basis. This fitted a common arbitrage mindset: small spread, short time, seemingly low risk. The typical arbitrage trade here was straightforward. An investor would buy Cypress Garden shares at around $7.50 and simultaneously short 16 shares of HBJ to hedge market risk. This hedge was meant to neutralize overall market movements so that the investor could simply earn the spread when the deal closed. In theory, if the merger went through as planned, the arbitrager would receive HBJ shares, use them to cover the short position, and lock in the profit. But reality is very different from the theory. And this is where the author's warning begins to matter. Risk arbitrage is not risk free, it is risk misunderstood. The trade appeared mechanical and safe, but it relied heavily on the assumption that nothing unexpected would happen before the deal closed. At this stage, investors were focused on pricing efficiency and not deal fragility. The key point from this deal was that it was completely clean, it was very well hedged, and mathematically attractive. But the real risk had nothing to do with the stock market. It has to do with the events that has not yet occurred. And now I hand it over to Shivam for explaining the after result of these announcements.
Continuing the topic from where the meat left. So let me start with explaining arbitrage. Arbitrage means buying one security and selling other related security at the same time to profit from a price difference. In merger arbitrage, investor buy the target company share and hedge the risk by short selling the acquiring company share. Hedging is meant to protect against broad market movements, not against problem within the deal itself. So just week before the deal was expected to close, an unforeseen deal-specific event occurred. Cypress Garden suffered a major sinkhole incident, which caused physical damage to the property and raised security concern about operation and asset value. This was not a market risk, but an operation shock, which refers to an unexpected event that directly affects the business. As a result, uncertainty emerged around whether the transaction would close on the original agreed terms. At the same time, HBJ stock price rose sharply to around $60.75 because arbitrageurs were short HBJ share, meaning they borrowed and sold the stock expecting it to buy later at a lower price. The rising stock price made the hedge increasingly expensive. If the deal failed or was renegotiated, losses could increase rapidly. Eventually, the deal terms were revised. Instead of receiving 0.16 HBJ share, Cypress Garden shareholders were offered a fixed cash equivalent value of $7.9, calculated using a 10-day average price. For arbitrageurs who had bought Cypress Garden at around $7.5, expecting roughly $8.3. This resulted in a loss of $1 per share, despite the deal completing. So the key learning is clear and extremely important. Hedging removes market risks, not deal risks. Operational accident, legal issue, or renegotiated term can still materially impact returns. Risk arbitrage is therefore a probability-based strategy, not a guaranteed one. When we hear the word bankruptcy, we usually think of failure, permanent loss, and end of value. Most investors walk away, but in reality, bankruptcy can sometimes do the opposite. It can wipe out the broken financial structure and unlock enormous hidden value. The case of Charter Medical Corporation is a classical example of this idea, often referred to as an orphan equity. Charter Medical was not a weak business. It was a major healthcare operator in the US, running 78 psychiatric hospitals and 10 conventional hospitals. These were real asset with patient revenue and operating cash flow. The company problem was not operation, it was leverage. Simply putting, like the company had taken on too much debt. Before bankruptcy, Charter carried about $1.6 billion of debt, and the interest burden was crushing cash flow, leaving almost nothing for shareholders. In June 1992, the company entered a pre-packaged bankruptcy. A pre-packaged bankruptcy means the company and its creditor agree on its restructuring plan before filing. So, when the company goes to court, the solution is already decided, allowing the process to be fast, controlled, and focused on fixing the balance sheet rather than fighting legal battles. The restructuring created a dramatic structural change. Debt was reduced to from $1.6 billion to $900 million. Ownership was completely recast. Former creditor became a new shareholder, while old shareholders were heavily diluted and left with only a token stake. Bankruptcy did not improve hospital overnight. What it did was more powerful. It reduces interest costs and gave the business room to operate and stabilize. After the reorganization, the stock traded at just over $7 per share. It was cheap not because the business was broken, but because of bankruptcy stigma. Institutions avoided it, analysts ignored it, and liquidity was poor. This is what meant by orphan equity, a stock that is neglected and unloved despite improving fundamentals. In December 1992, investor Joel GreenBlatt analyzed the company. He focuses on free cash flow, which is cash left after operating expenses and capital spending, the cash that truly belonged to owner. Charter was expected to generate $2.5 to $3 of free cash flow per share, yet the stock trading around $7. Based on comparable company, he believed fair value was close to $15. Over the next year, costs were controlled, conventional hospital was sold, operations stabilized, and cash flow proved rare. As fear faded and confidence returned, the stock tripled and Greenblatt exited with a large gain. The lesson from charter medical is simple but powerful. Bankruptcy can be value creating, not just destructive. Debt reduction is a structural lever. When debt disappears but the business remains, equity can rise dramatically if you are willing to look where other refuses. This is the end of book. Now current awareness and economic indicator will be discussed.
Let's start with the current awareness and economic indicator. So few of my friends were confused that why is the market up but the portfolio is down, and why is the portfolio look so red when the index is saying that it is having a positive growth. So let's unmask this index illusion. If I tell you that my overall percent was 80%, does that mean that all of my subjects were scored 80%? It does not, right? It might be that few of them are doing very great, and the remaining two, three subjects I was actually failed in it. This same applies in the market. Break the market into parts: large cap, mid cap, small cap, micro cap, and then question: are each of the segment doing great, or just few of them are doing great and others are terribly falling? This is what actually market breadth tells you. Nifty and Sensex are indexed. They are not the total market. Nifty and Sensex have few of the large company, and major part of this index is large companies. So even if the mid company and small company are doing terribly wrong, the portfolio of the index fund will look very high. Let's understand what market breadth is to the simple example. Assume there are 100 stock and all are trading at 100. 25 stocks have fell less than 10%. 50 stocks have fell 10 to 20%, and rest of the stocks have fell 20 to 30%. What this tell you is only 25% of stocks are strong and rest 75% of the market is actually correcting very badly. This means that the breadth is very weak right now. 25% of stocks are doing great. And if large caps are doing great, then the index will look very positive. And your portfolio lies from the mid cap, small cap, micro cap, and everything, right? So your portfolio will act according to the stocks that you have invested. If the breadth is weak, your portfolio will bleed. 60% of the index is out of the 610 companies, top 610 top companies who are actually doing great, and the rest are correcting badly. So if you don't own the specific giants, then you cannot expect a high returns. There are few sectors that can be a portfolio killer. For example, every year there are few sectors that don't do great, and last year, media, real estate, and IT performed really bad. You have stocks in those sectors, then your portfolio might look down as compared to the indexes, which has only large companies. Passing over to Yugbeh, he will continue the next topic.
So, talking about the recent geopolitical tension in the world, uh, the one thing that comes to our mind recently is the US has attacked Venezuela. So, the US says they sanctioned Venezuela because of the human rights and drugs. But let's look at the facts. If it were about the human rights, they would have attacked North Korea. If it were about the drugs, they would have attacked Mexico. They don't. Why? Because North Korea has nuclear bomb and Mexico owes them billions. So the real reason is beneath the ground. Venezuela holds the largest oil reserve in the world, with containing 303 billion barrels of oil. And then second comes the Canada, and third the Saudi Arabia. So decades ago, Venezuela was the fourth richest country in the world because they partnered with US companies. But then come the Hugo Chavez. He ran on a Robin Hood platform. He decided Venezuela should own 100% of the oil. So he seized the assets of the American companies like ExxonMobil. At first, it worked, but instead of investing that money, he spent it on the subsidies, selling goods for 50% off. This destroyed local businesses because no one could compete with the government. Then he made a fatal mistake. He fired 18,000 oil experts who disagreed with him and replaced the loyalists. They broke the machinery, production basically collapsed. So why the US still cares? Today, the US produces its own oil. Why do they will still care? There are three reasons which are there. The first one is the heavy crude. The US refineries are built for Venezuela's specific type of heavy oil. They need it to run it efficiently. Second, the hidden treasure. Venezuela sits on the Arco Minero, billions of dollars in gold, diamonds, and coltan, which is a specific thing which is used in phone. And third, the geopolitics. China and Russia are loaning billions to Venezuela to gain a foothold in the South America region. The US cannot allow its rivals to build bases in its own backyard. Now, here are the three lessons that we learn from this tragedy is the first, the distribution versus creation. You cannot end poverty by just handing out money to the poor. You have to create jobs. Second, the resource curse. Never ever rely on just one industry. When oil crashed, Venezuela had nothing else to fell back on. Third, the power. Never mess with United States. You cannot fight the world's financial superpower with just ideology. Thank you. The next topic will be explained by Shivam.
So, when we hear the headline, rupee falls to 89 against the dollar, we usually panic. We assume the economy is weak. But today I want to explain why this fall in rupee is not a bad news and it actually a smart and strategic move for India. To understand this, you must know the three technical terms. First, nominal exchange rate. This is a number we see every day, like rupees 89 per dollar. It is simply the price tag of a rupee, just like the price printed on a product. It does not tell us whether the rupee is expensive or cheap in reality. Second, real exchange rate. This adjusts the nominal rate for inflation differences. In simple words, it answers the questions after considering rising prices. Are Indian goods actually cheap or expensive compared to global goods? And third, the most important, real effective exchange rate, REAL. REAL does two things. It compares the rupee with a basket of about 40 trading partner currency, not just the dollar, and it adjusts the inflation differences across countries. Think of REAL as a true value of a rupee in global trade. The benchmark here is 100. Read above 100 means Indian goods are expensive, bad for export. Read below 100 means Indian goods are cheap, great for export. Now here's a big shift. Indian real has sharply fallen from 108, meaning very overvalued, to around 97.5, which means the rupee is now undervalued and competitive. This is the real reason why the falling rupees is good news. And why this happened? There are two key drivers. First, the rupee weakened against many global currencies, not just the dollar. This made Indian export cheaper across markets. Second, Indian inflation dropped to an extreme low, 0.25%, while inflation in the US and Europe stayed between 2% and 3.6%. Because prices in India are rising much slower, Indian goods naturally become cheaper over time. And thirdly, the Reserve Bank of India has shifted strategy. Early it aggressively defended the rupee. Now, under what the International Monetary Fund calls a claw-like arrangement, the RBI is allowing the rupee to depreciate gradually. Why? To protect Indian industry from cheap Chinese import, to prepare for possible US trade tariff, and to boost export without hurting consumer with inflation. So, in simple terms, what looks like bad news in headlines is actually good economic underneath. Now let's talk about a transformation taking place in Indian shipbuilding industry and why it's becoming a major strategic and economic opportunity. To begin with, the government has created a strong policy support system in this sector. Under the Shipbuilding Financial Assistance Policy, Indian shipbuilders receive up to 20% subsidy for vessels built domestically. This significantly reduces costs and improves competitiveness against global shipyards. Along this, the Atmanirbhar Bharat initiative has increased domestic manufacturing and boosted naval and commercial ship orders. As a result, nearly 67% of shipbuilding inputs now come from Indian industry, strengthening the entire ecosystem. Looking at a long-term direction, India has set a clear vision by 2030 to become one of the top 10 shipbuilding nations globally. This vision focuses not only on defense vessels but also on commercial ships such as cargo, carriers, tankers, and support vessels, positioning India as a global shipbuilding hub. Now coming to the growth potential, the industry is projected to reach around $8 billion by 2033, growing at an estimate of 60% compound annual growth rate. One major reason for this growth is that major Asian shipbuilding countries are operating at full capacity. This has created a global supply gap and India is well placed to capture this overflow of international orders. Finally, the economic impact is significant. India currently spends close to $75 billion on foreign flight cost. Expanding domestic shipbuilding capacity can reduce this outflow, improve trade efficiency, create high-skilled jobs, and strengthen economic self-reliance. In short, Indian shipbuilding is evolving into a strategic growth sector supported by strong policy backing, global demand, and a clear nation vision. From now, Meet will give you more insight on shipbuilding industry.
Thank you, Shivam. And now, building with the momentum. What truly sets this space apart is that Indian shipbuilding is no longer operating project by project. It is moving into a program driven manufacturing model. Standardized designs, repeat naval platforms, and long term contracts are improving execution speed, cost control, and revenue visibility. This shift matters because it changes a shipbuilding from a cyclical business into a more predictable one. That is a fundamental transformation for capital intensive industries. Another important engine of growth is ship repair and life cycle services. As global fleets expand and age, maintenance and refits are becoming a stable, high margin opportunity. Indian shipyards are now positioning themselves not just as builders, but as long term service hubs. And if we look at the same time, the industry is benefiting from deeper private sector participation. Private players are introducing modular construction, digital design, and tighter project management. This improves productivity without requiring proportionate capital expansion. Demand is also evolving domestically. India's growing trade, energy needs, and coastal movement are driving demand for specialized vessel support ships, offshore vessels, and coastal fleets. These are segments where Indian yards have a natural home market advantage. Beyond economic, shipbuilding has now become a strategic national capability. It is linked to defense readiness, supply chain security, and India's position in the Indo Pacific region. That strategic importance ensures policy continuity and long term order visibility. So, the story today is no longer just about incentive or subsidies. Indian shipbuilding is entering an execution led growth phase where scale, specialization, and strategy came together. And that is what makes this opportunity both structural and durable rather than cyclical. So now in the final slide, we'll be talking about how economy is moving forward through the help of economic indicators, some of which are e-way bills, GST collections, and railway freights. So, over the last few years, India's growth story has been shaped by clear shift in economic strategy. When the economy faced disruption, the government stepped in as the primary driver, supporting domestic production, MSMEs, and supply chains through policy support and subsidies. That intervention ensured factories restarted and goods began moving again. At the same time, the growth model evolved into an infrastructure first approach. Large investment in roads, railways, and logistics corridors fundamentally changed how goods move across the country. As connectivity improved and transport costs fell, interstate trade became easier and more economical, naturally increasing the volume of goods in transit. A critical structural change came from GST maturity and formalization. Better compliance, enforcement, and digitization meant that a larger share of trade shifted from informal channels to invoice-backed formal movement. As a result, EV bills began capturing more of the real economy rather than just incremental activity. This is also clearly visible in the numbers also. GST collection nearly doubled in last 5 years. And we can say that this was inflationary led growth. But e-way bills and railway freight volumes are not just inflation. They are confirming that this is a physical movement of goods. What's important today is the change in the nature of growth. Freight capacity is largely stabilized at high levels. Commercial vehicles, rail network, and logistic systems are already in place. And the key shift now is that growth is being driven by efficiency and utilization, not just expansion. And if we look, it also seems that India's economy is entering a phase of steady, sustainable growth. Goods movement should continue to rise in high single digit, supported by infrastructure execution, formalization, and stable demand. Rather than overheating, the economy appears more organized, resilient, and logistic efficient. This outlook is based that freight capacity is already in place, utilization is rising across road and rail, and this activity is translating into higher formal value, which historically leads to stable, not volatile near-term growth. And essence, if we see the rising EV bills are not just showing growth, they are also showing a structurally strong Indian economy.